Hello there and welcome. I'm Tushar Chande. Are you new to technical analysis and you want to get better? You've come to the right place. You see all those technical indicators in the blue box? I've invented every single one of them and a whole lot more. My indicators are very popular and widely available. Now, if you want to trade on a little bit longer term basis and don't want to trade short term, hey, I can help you with that. So let's get going. Now, if you want to be consistently profitable over many trades, you have to be able to answer three important questions for every trade. How strong is the trend? Where do you want to get out? And how should you size your position? And I'll show you how to answer these questions for my long-term system. And this is specifically how we'll do it for the long-term system. We're going to measure the trend strength with long-term bands. We're going to use a trailing stop called a volatility exit, and we're going to risk between 1 and 3% of the available capital so that even if the trade goes against us, our approximate loss will be the amount of money we have risked on this trade. So let's keep going. Just a little bit of housekeeping. Here's a disclaimer to remind you that markets are random, that past performance is not necessarily indicative of future results, and all systems are designed with the benefit of hindsight. So little skepticism on your part might well be worth it. So let's keep going. So let's look at a chart for Devon Energy. This is a daily chart and the prices are from 2014 through current. There are three lines on the chart which together are called a band. There's a line in the middle and there's some formula that calculates one line above and one line below so that all three of them move together in some fixed relationship to one another, and therefore they work together as a band. There are many different ways to calculate bands, but for now let's just look at how we want to use them. All we care about is, are the prices above the band, are the prices between the bands, or are the prices below the band? And our trading strategy says that prices are strong when they are outside the band, and all we care about is trying to trade or find stocks or instruments that are outside these bands and trade them with a trailing stop. This is a close-in of the daily chart of Devon Energy, where we show you the region in this blue area, blue circle, where prices first rose outside the band, and then you see it sort of moved higher, but with several pullbacks along the way. So the main challenge for us is to either not use a trailing stop at all or to use a trailing stop that can be quite wide so that it can absorb a lot of volatility, i.e. a lot of movement back towards the bands without actually changing the trend, i.e. falling below the upper band. So in my package for MetaStock, I have templates for the long-term system, as I've highlighted here, which does the calculations for you. So let's apply this to a couple of charts and see what the system does for us. So here's the template applied to the Devon chart, and you see that the upper band is visible here. We have sort of a high channel just to show you where the trend was. The blue arrows show us that the trend is continuing. The red dots represent a trailing stop. And you see from time to time prices went in here, came back down, so we're stopped out here. Again, we went long, got stopped out here, went long, got stopped out here, went long, got stopped out here, went long, and we're still long. So this illustrates how the process works. If you use a relatively tight trailing stop, you could get stopped out. We bought a new high, we kept going till we got stopped out. We bought another new high, then we got stopped out relatively early. We got another high, we bought that, we got stopped out, we got another high, and so on. So you see that how far the trailing stop is away from the dotted green line will determine how easily we'll get stopped out. And of course, we can set that to be wider, so we will get fewer stop outs, but it'll also be slow to react towards the end of the trend. Or of course, you have the option of using the band itself as a trailing stop. So you could say have taken this entry and then just waited all the way through without getting stopped out. So there are different ways to trade long term, and this is just an example of that. This is still the Devon chart to give you a little better understanding of how the process works. The green band, of course, is our measure of trend strength. Everything outside the band we want to trade. We're buying against this dotted green line shown with the green arrows, and the circles and the red arrows show you where we exited had we used this particular stop. So we would have entered here and exited there, re-entered here, exited there, re-entered here, exited there. Now you could say, why are we getting all these entries and exits? The short answer is we don't know what prices are going to do. So we have to follow a process. Sometimes it may prove to be a process that gives us a lot of exits, as we are seeing in this case, or it could give us a very smooth trend depending on what the market does, as we are seeing in this case. So because we don't know exactly what the market is going to do, we sort of have to make some assumptions, and the way the system is set up is we use the same rules on every trade, on every market where we get the signal, so that there is no optimization. And in a way, that's a more robust way to trade. It's less reliant on prior assumptions about what the outcome of the trade will be. So this template or this chart shows you how the width of the trailing stop is set. We're using the 100 bar high as a reference. We have some measure of volatility, which is a sense for how much prices are bouncing around. And we are multiplying that by 6 and subtracting it from the high. So the larger this multiplier is, the further out you will be from the high. So the less likely you are to be stopped out, but then you'll also be slow at the exit. So it's a trade-off. And since we don't know exactly what prices are going to do, we pick a value and stick with it. Sometimes it works great, and sometimes it works sort of okay. So this is the Devon chart again, but you see that the red dots are now calculated with an 8x multiplier instead of a 6x multiplier. 8 is bigger than 6, so which means that we are further back from prices. I've kept the blue circles from the 6x exit. So you see that if we entered there, we would not have exited here. We would not have exited there. Neither would we have exited there. So we could have bought it here and just absorbed the volatility and followed it all the way to here. So where you set your stop, i.e. your exit, is important. But since you don't know what the market is going to do, you have to make some assumption. The default value is 6, but you can use any value you wish. Here I'm just reminding you how we calculate trade size. If you have the entry price and the exit price and the risk per trade, which is say 1 or 2 or 3 or 4% of your available equity, then the quantity is simply Z divided by X minus Y. And this gives you reasonably good control on volatility and losses if you do a lot of trades over a long period of time. Now, my tools are built for scanning with MetaStock 18, so let me show you an example of how that works. The MetaStock Power Console allows you to set up a scan. So here in the upper box, we've picked the 40E350 band as what we want to use for the scan. And in the lower panel, we've set My Energy 121 or just 121 stocks in the energy sector for the purpose of the scan. So let's look at the results. And this is a summary of the scan results. They were on 13th of June. We only used the bands, and 51 out of about 121 stocks in the energy sector were above the bands. And these are just additional statistics that we calculate for our reference. So the first two stocks, when I sorted by the Chande trend meter, were PBF, CVR, and Scorpio. So let's look at the charts for PBF Energy and Scorpio tankers just to see what they look like and whether the scan itself makes sense. So now here's a chart for PBF Energy. We can answer the 3 questions we need for every trade. Is the trend strong? The answer is yes, because it was above the green upper band. Do we have a trailing stop? Yes, we have these red dots, which is a volatility exit. And 3, can we size the trade? The answer is yes, because we know where we were getting in on the day of entry. We know where we would have gotten out. So we can use this gap, as I've shown you, is Z, the gap, the Z divided by X minus Y, where Z is the risk and X minus Y is the gap. So yes, we can answer the 3 questions we need in order to put on this trade if we wished. So this is a chart for Scorpio tankers. I have a few more technical tools on this chart. The upper chart has the Chande trend meter, so you see that the trend meter was above 90 and telling us that yes, the trend is very strong. We also have the upper band, so anytime the prices go above the band, we know it's very strong. And you see that the rise above the band coincided with the CTM value of 90, though it doesn't have to do that every single time. And then we have the volatility stop, and the green arrow gives us the entry date. The day before, we knew where the entry was going to be. We know our trailing stop, so we have the gap. So we could have calculated the size of the trade. And now all we'd have to do is keep following the prices higher until they come and fall below the trailing stop, which we could put as an order in the market. So this is an example of a historical eyeball test, just to show you that this pattern of the prices rising above the upper bands can occur historically. This is the ARK Innovation ETF. We have daily data. The two orange lines highlight the area where prices rose above the upper band and stayed there. Again, the three green lines together act as a band. We're not interested if prices are between the bands if you wanted to trade at all. And if they're below the bands, you could consider going short. If they're above the bands, you'd consider going long. And we have the 8x trailing stop. So in terms of putting on a trade here at this point of entry, we knew where to get in. We have a trailing stop, so we know where to get out. We have our risk parameter, so we can size the position. And then you'd have to wait patiently for the prices to come back down and knock you out. So let me give you another example. This is just a daily chart of Microsoft, which is an arbitrary choice. And you can see that there are times when Microsoft rose above the upper band, and in some instances got pretty close. So again, you can trade this using this long-term trend following model. And all you'd have to do is enter, then know where your exit is and calculate your position size. So it's as simple as that. So let me give you an example with the Amazon chart. This is a chart for Amazon. Again, I picked it because we all know about the company. Again, we have the three bands, and you see that Amazon rose above the bands and stayed there for quite a long time. It rose here again and again stayed there for quite a long time. And as we've said, we're only interested when prices are outside the bands. And clearly, a company like Amazon could sustain a move outside the bands and stay there. So this is an example of a long-term investment or long-term trade, if you will, using technical analysis that allows you to capture the price action when it's significantly stronger than average or usual because it's outside the bands. So here I have just the strip of a chart that I showed you for the ARK Innovation ETF. We want to review what we need to succeed. The yellow arrow shows the upper green band when prices rose above the upper green band. So that's our measure. The first question, is a trend strong? It is when it's above the green band. Second, where are we going to exit? We have the volatility stop with the 8x multiplier. And three, how to size a position? We just need the gap between the entry point and the exit point just before we place our order in order to calculate the trade size. So it's as simple as that. And you can use it perhaps in your own trading. So the scan and all the other tools are available in Tushar Chande's complete toolkit from MetaStock. The whole package is very easy to use. It's simple to apply. It's powerful because a lot of interesting ideas are bundled into it. Most importantly, it's very clear. There's no ambiguity about where to get in and where to get out. You can use it on any time frame from say 1 minute out to a year if you wish. And you can use it anywhere in terms of any exchange, any instrument, any type of market condition. So I hope you'll consider using this for your own trading process. Well, thank you very much for staying all the way to the end of the slide deck. I hope I'll see you soon, but in the meanwhile, you can check out my blog at chandeindicators.substack.com. Thank you very much and have a great day.